Hello, and welcome back to our podcast series, Collections Conversations, sponsored by our friends at C&R Software. The focus of today's episode is regulatory compliance. Now, obviously, we all know that debt collection is a heavily regulated space, but I don't think we spend nearly enough time thinking about the origins of those regulations. Why were they put in place? What consumer harms were they intended to prevent? And how do they apply to a market that is constantly being reshaped by competition and by the relentless evolution of technology? To talk about those questions, I was thrilled to be joined on this episode by John McNamara. John is a longtime executive in the debt collection space and is currently the Chief Growth Officer at Avtal. He also spent more than 8 years working in various leadership positions within the markets team at the Consumer Financial Protection Bureau, where he was, among other things, responsible for working on the implementing regulations for the Fair Debt Collection Practices Act. Now, as John points out, very amusingly, the Debt Collection Practices Act was originally passed by Congress in 1977, and it contains the word telegraph. To me, that tells you everything you need to know about the challenges of operating in and regulating this very dynamic industry. John and I talk about those challenges, about how supervision and rulemaking in debt collection is actually done, about where technology has made debt collection better, where the opportunities are to continue to innovate, and how the current deregulatory era that we are in will shape things moving forward. Put simply, we cover a lot of ground, and John is the guy to have this particular conversation with. So again, I am delighted to bring you this conversation with John McNamara, episode 3 of Collections Conversations. Okay, John, thank you for joining me.
Alex, it's a pleasure. I'm a big fan. Thanks for having me.
Well, I am a big fan as well. You didn't know that because you were busy working at the CFPB, I think, the last time that we got a chance to briefly say hi, and have been a close follower of the work you did at the Bureau. I know you've kind of bounced back and forth between the private sector and kind of the regulatory side, which makes you the perfect person to ask some of my sort of nerdy collections, compliance, regulatory questions. So if you don't mind, I'd love to just jump right in.
Happy to help.
Thank you. I appreciate it. So the first thing I wanted to ask about, just kind of to level set a little bit, is when you were at the CFPB, I mean, I know you did a tremendous amount of work, obviously focused specifically on debt collections and then more broadly as well. And as a part of that, you engaged a lot. I remember seeing kind of from a firsthand perspective with industry and trying to sort of interface with industry. What misconceptions, I guess, did you notice from industry in terms of like how they thought about maybe the Bureau or the way that the Bureau approached regulating the debt collection space?
Yeah, so they missed the mark frequently on a number in a number of areas. One was oftentimes they didn't understand the voices that informed the Bureau. And I had to make that clear that those voices included consumer advocates, which have always been relatively effective at getting into the director's ear. Sure. The complaint portal, that's a voice. Oftentimes that voice lacks nuance or context. They listen to that voice. And that markets is this island, always relatively small. I think the biggest markets was like 50 people, sure. Roughly 50 people, but that's out of 1,700 folks. And that our voice, we have to be very articulate, to be influential and actually affect policy. And we couldn't always do everything. I think sometimes, and I think I've upset some industry members on a number of occasions when I said, listen, look at the name. You know, we're not the Small Business Protection Agency or the Industry Protection Agency. It helps when you tell us of actors out there that are making things problematic. And I'm happy to filter those to the right folks on the federal side or even the state side where it'll help. But there's that. And then I think it always broke my heart a little bit when industry would say, you guys run Sabrifa just to basically as window dressing. You have no intention of using that information or listening to our voices. And I found that Regulation F is the one I can speak to with the most authority, and that's why I joined the Bureau to work on it. But I mean, we substantively changed the approach to Reg F based on what we heard the voices of small businesses during Sabrifa. And that was the whole segment on right consumer, right amount, which would have required data flows from creditors to debt collectors and back from debt collectors to creditors. So 1/3 of that rule was set aside based on what industry said.
That's fascinating. I mean, I think it is really interesting, right? Because having kind of talked to folks on both sides of it, I do think the gap you describe is really real, right? Where it's like there's this perception from industry that either you don't listen, or if you don't listen, you don't have as much like ability to like affect changes as they might think. And the reality is, and you did a good job outlining it, particularly with like Reg F, like there's just things that are hard to balance across lots of different stakeholders, right? I mean, that's another thing I've noticed about anything on the regulatory side is, everyone, I think with effective regulation walks away kind of mildly unhappy, but with something they can kind of live with. And, you feel as if like you didn't get what you wanted, but you don't see all the other parties that were working like sort of in opposition to you who also didn't get exactly what they wanted out of that whole experience.
Yeah, actually, I'm glad you mentioned that because it reminds me of a conversation I had with then Director Kraninger. So Reg F started under Richard Cordray and completed, appointed by then President Obama.
And can you give us a little background on kind of Reg F, just for those who are less familiar?
Sure. Regulation F is the implementing regulation for the Fair Debt Collection Practices Act, which by the time we got around to working on it, it was a very, very old statute enacted in 1978. So it hadn't really been substantively updated in that entire time. So approaching so FDCPA actually has the word references telegrams in it. That's how old it is.
Oh my God.
And it was on the rulemaking team that I was a part of for a long time, led by the very able and incredibly credible leader, Kristen McPartland. But that was one of our battle cries is no telegrams in this damn thing. We weren't going to put things that would sound anachronistic within a year or two of the regulation. But, so the Fair Debt Collection Practices Act governs the behaviors of third-party debt collectors, not first-party, third-party, hadn't been updated. It's a high area of complaint, lots of accusations of abuse. Certainly, the debt collection industry has a checkered past. And the implementing regulations were designed to basically bring it up, take into account modern technology, and create a framework for collections that allowed to the consumer to maintain their dignity, but also gave clarity to debt collectors too, who are often sued for technical violations of the law. But the conversation with then Director Kraninger was, she frequently asked, she'd say, John, how will industry react to this? And I would give my best opinion of how they would react, but she would also ask about advocates. And when the rule rolled out, I was talking to her about something, and I said, listen, we have achieved a symmetry of outrage and vitriol. And she looked at me, horrified. I'm like, no, Director, that is a great thing. I mean, if
we accomplished our goal.
If both industry and the advocates are outraged, like that's probably right. You don't want one side being really delighted and the other not, because you missed the mark. And I don't hear too many advocates complaining about Reg F now that it's been out in the wild for several years. But industry actually will approach me and say, we think it's a solid rule. I mean, we don't like the CFPB, but we like Reg F. It's reduced complaints, or it's reduced lawsuits against collectors that don't really involve harming consumers. They were technical violations, many of them around the model validation notice. So, I think that's exactly how that works, where we try to go for that sweet spot of giving the industry clear rules of the road for responsible industry to follow, but at the same time, giving consumers more protection from abuse.
Yeah, I think it's such a hard balance to strike, and it is hard because, like, depending on who has the ear of a person at a time, they might only hear one side of it rather than the whole thing. And you mentioned a couple things there that I wanted to dig into. The first one was consumer complaints, right? So, obviously, consumer complaints have been, since the very early days of the Bureau, a major input into what the Bureau does, how it focuses. Even to the degree of like which specific entities or parts of the market it looks at or decides to prioritize. But at the same time, as you also mentioned, the consumer complaints can sometimes lack nuance or lack sort of the surrounding context. I'm curious how both complaints sort of drove policy and drove rulemaking while you were at the Bureau. And then more recently, I know you're still a close student of the Bureau even since you've left, how you've seen that kind of shift and the role that complaints play today.
Yeah, no, that's a great question. And again, Dodd-Frank mandated the creation of this database. And the database is to intake any expression of consumer dissatisfaction with a consumer financial good or product. Now, for debt collectors who lived in the post-FDCPA world, their experience, and I'm part of it, I'll often say our when I'm talking about both debt collections and the Bureau. So I may be very confusing to you and your listeners, Alex, but I apologize. But like prior to the Bureau, a complaint from the Federal Trade Commission was relatively rare if you were a responsible provider. You just didn't see very many of them. And if you got too many of them, you pretty much knew that the Federal Trade Commission was going to open an investigation. You just didn't see very many. Same thing for a complaint from a state attorney general. So when the Bureau rolled out with that complaint database, expression of dissatisfaction, things skyrocketed. Sure. And collectors saw many more complaints, and they've hated the complaint database ever since. And I would have to refer them back to the language of the statute. When I was there, we used the complaint. We looked at that complaint data, but we tried to normalize it. And to me, the best example of best rough example and overgeneralization of how we normalize would be Portfolio Recovery and Encore Capital are two of the biggest debt buyers, and their revenue at the time was roughly $1 billion per year for each of them. One would expect them to have roughly the same number of complaints. So, if we saw one markedly higher than the other, that was a problem. But if we saw a small agency or a smaller agency with a number of complaints, okay, that was going to draw the attention of the Bureau, may draw the attention of enforcement and a CID. If it's large enough to be supervised, it's likely to draw an examination. So you had that. But then more importantly, we looked at the egregiousness of the complaint. So roughly year in, year out, 40% of complaints are the consumer saying continued efforts to collect a debt not owed. Sure. Gandhi Eswaramurthy was my debt collection program manager for a long time. He came from Citibank. I said, Gandhi, if 40% of the accounts Citi placed had the wrong balance, like, would you be able to even operate? And he goes, of course not. I think when consumers and debt collectors disagree and they agree to disagree, it turns into one of those kind of complaints. Now, what's happened lately, and I'm so glad you asked that question, Alex, is there's a massive surge in complaints about credit reporting. And what I've noticed specific to debt collections is I suspect credit repair organizations are behind a lot of them. That's my opinion. It's my opinion, albeit highly informed, that they're saying, wait a minute, regulators are going to notice complaints more if they're egregious. Don't say that your credit report is wrong. Say that the debt collector is threatening to ruin your credit by saying your credit report is wrong. And sure enough, when I started looking at the complaints, the surge among debt collectors was among those debt collectors who furnish collection trade lines, which are typically healthcare providers. Increasingly, debt buyers do it. And then folks who are in the property management business, apartment rental, things like that, they all furnish. And guess what? They all have higher complaints. Sure. And then from time to time, there would be campaigns to jack up the complaints in a particular area, not just debt collections. And quite frankly, I always encouraged Chris Johnson and the folks who lead that in the interest of the integrity of the data, you should publicize that when you know that the numbers are off because of a particular reason.
Sure. Yeah. No, that makes sense. And I'm glad you mentioned the kind of credit reporting angle, because that brings up another thing that I was actually talking to someone about recently, which is we try to categorize these things into different buckets, right? Like, this is first party, this is third party, this is recovery, this is debt buying, this is credit reporting, which is a category in the consumer complaint database that is always overflowing with complaints. And this is like lending. Like, we separate all these different buckets together. But the reality is, from the consumer's perspective, these are all a bunch of like options that sit on a very like tight continuum of different choices, right? And I was talking to someone about like the process that a consumer might go through when they're delinquent, like on a loan, right? And they might shift rapidly between, okay, well, I want to get a debt consolidation loan, so I go out and I shop for a debt consolidation loan, but I didn't get a debt consolidation loan because no one would approve me. But one of the companies that I applied for a debt consolidation loan sold my data to someone who wants to sell me like debt repair services. And so now I'm talking to that company. And then as I start to like repair the debts that I have, they then decide to sell me a debt consolidation loan. So we go back onto the lending side. And then that becomes a question of whether they're going to furnish my data back to the bureaus or not. And so like the thing I'm trying to illustrate is, one consumer experience and one sort of like set of delinquent debts can cross over between a bunch of different product categories, a bunch of different business models, a bunch of different providers. And I'm curious, especially given like markets, the markets group of the CFPB was so good about being thoughtful and looking at like the interconnectivity of different players in the space. What was your opinion of like how to disentangle all of those different pieces? Because to me, that makes it really difficult from a rulemaking perspective and an enforcement perspective when there's so many different hands and different products and different parts of the ecosystem kind of smashing together.
Yeah, no, actually, when I was there, we initiated coverage of the debt settlement, for-profit debt settlement space, the nonprofit debt management plan space, as well as credit repair. And that led to, it was the last normal day at the Bureau before COVID. We actually had an all-day convening where we we tried to bring the entire ecosystem together. We had issuers there who absolutely do not like for-profit debt settlement companies. Sure. We had bankruptcy trustees, consumer advocates, and we basically gave everyone air to talk about this. And in essence, it was everyone the consumer might encounter if they typed in a Google search that said, I can't pay my bill, or I'm having trouble paying my bill. And it's still difficult to untangle, but so much of it goes back to, and I'm a pragmatic policy person, or I was at the Bureau. You could rip out a bunch of that by getting the credit reporting out. And it's not that I'm against credit reporting. I'm actually for negative but accurate credit reporting, but I'm against the inconsistencies. And if the one thing I'd love your listeners to understand is this is largely unknown when it comes to credit reporting, but debt collection trade lines, not just healthcare debt collection trade lines, but utilities, telco, all of those sorts of things are never furnished by someone who has direct and continuous access to the system of record. If you're in the healthcare space, it's quite likely the provider may force you to furnish. And if you don't furnish, you are basically, they'll just go next door to someone else who will. And I think the Bureau did some research. I believe it was Ken Brevoort did some research on this that showed that in the healthcare debt collection space, I think something like 96.5% of all of those trade lines were furnished not from the system of record by the provider, but by this third party, which means the accuracy of that information may always be in doubt. And unless in a hospitals are built to heal people, not to count the money.
Sure.
Bank systems are absolutely rock solid, built to count the money and know the balance. So you're asking these collectors to basically take this ridiculous risk. So when they do take that risk and they do furnish, guess what? It draws the credit repair organizations out. They see those trade lines and they begin a process of jamming where they file a direct dispute to the furnisher, an indirect dispute to all three of the credit reporting, Equifax, Experian, and TransUnion. And then the latest addition is to file a complaint with the CFPB. So you've got all that work to manage these. And guess what? Wash, rinse, repeat. The money that you've gone through them, it happens all over again. And the consumer, in my opinion, derives dubious to no value from these efforts. And, I asked this question in a room full of consumer advocates once, and it wasn't on the agenda, but I had to ask them what they thought of credit repair organizations. And the room basically erupted. And they felt like credit repair organizations, while the consumer is trying to make a good faith journey to a better state, maybe even, God forbid, build multi-generational wealth, they get intercepted in that journey and crushed because they get lured into a credit repair organization that takes a minimum of $100 a month times 6 months and maybe more with false hope. At the same time that they have to know that many of those trade lines will go right back on, even if they do get them off. And the Bureau, my team did research on that too, to show that these trade lines reappear when accounts are reassigned. And the research also shows that these things have some impact on one's FICO score, but it's not big. It's not going to move a deep subprime into prime. It's not going to move the needle. So they're paying a lot for almost nothing. But if that went out of there, a lot of this, it would be a better state for the consumer. And I was talking to Jonah Kaplan, who was my program manager for consumer for credit reporting. And I said, my God, Jonah, maybe we started this nightmare. And he goes, what do you mean? I said, well, we worked hard on this open credit score where we made credit scores more available to consumers.
Sure.
Maybe we created this expectation. I mean, I'm old enough to know, Alex, like I didn't talk about my FICO score when I was in my 40s.
Right.
But we've got people in their 20s that are obsessing about their FICO score. Like,
totally,
it's unhealthy.
It's funny you say that, John, because one of the things that's come up in this series a little bit over time is trying to think of the right way to say this, like the relationship between collections and financial health, right? And it's really fascinating to me actually because I think consumers tend to not think about these experiences the same way that it's perceived on the other side if you're the lender or the collector or the debt buyer or whomever, right? So if you're the consumer, you think about it as, I got a loan, and the loan that I got was like, honestly, it was picked out of a hat, right? It was picked of like many different providers. I was probably shopping for price. I probably didn't have any like deep substantive relationship with the company that I got the loan from. I got the loan for a specific transactional reason, right? I'm buying a car, or I'm refinancing debt, or I'm, doing an extension on my kitchen, or whatever I'm doing. I got a loan for a purpose. And really, like, where the relationship can really like create value and where you can add value is if I, the consumer, have a problem, right? Like I hit some snag with my finances and my cash flow, and suddenly I have an issue. And what we've remarked on in earlier episodes in this series is the irony that it's at that moment when the behavior of the providers on the other side actually changes for the worse. And suddenly, like, we don't value the relationship the same way. Suddenly we're being very like aggressive in trying to collect from you. Suddenly we're using the threat of furnishing negative data as sort of like a stick to try to like get the behavior that we want. And it just strikes me as kind of fundamentally backwards. And your example is a great one, right? I mean, like, over time, we've trained consumers to obsess more and more over scores and systems and what should I do here and how should I do this, when really, like, what we want is collectively as an ecosystem for you, the consumer, to get back on track as quickly as possible and be able to honor all of your obligations. And yet, like, a lot of this part of the ecosystem has been consumed by this like very complex multiplayer game that's kind of separate from the actual objective that we should be having for the consumer. Does that was a little bit of a rant, but does that make sense?
No, actually, I'm a big fan of rants, being a prime ranter myself. But no, it really does. And that's when I was having this conversation where I was like horrified is, did we create this expectation that isn't really that helpful for the consumer? And you are exactly right. As far as getting out of it, so again, I'm just reading all the press around the CFPB revisiting how they deal with complaints. And again, it's being painted by one side as, oh my God, the Bureau is completely catering to Equifax, TransUnion, and Experian. But it's like, Mark, as I said, is a small group. Within the Bureau, it would have been a very unpopular opinion to say, wait a minute, there's two sides to this story. Credit repair organizations and increasingly if you want to hear a rant, finfluencers. Oh my gosh.
Yes.
They're hurting so many consumers all over the place by telling them, stop paying this or do this, and your creditor can't do anything against you. I mean, literally, they're greasing the path to litigation, as we speak. Totally. And bots, the ability to file lots of these complaints at the same time. And it's a known thing that they do this, that credit repair companies send these massive disputes. And even the Bureau, we had a major enforcement action against Lexington Law, or Progrexion at the time was a public enforcement action. So that's a problem that sort of muddied all the credit reporting waters. And I think consumers, anyone doing financial counseling should say, listen, Alex, you're a subprime. Okay. It literally is, you're going to have to move heaven and earth. You're not going to be a super prime in the next 10 years. You might bump up a little bit. Let's show a history of good payment, but don't obsess about that number. Some things, having been someone who once was a lot heavier and lost weight, you can't weigh yourself every day.
Right.
Right. It's a longer journey than that. So you have to sort of accept that and move on. So a lot of noise about that. And then I wish I could get word out to creditors that I really think, and that's why I love what I'm doing right now, is I am a huge fan of digital communication with consumers. And I think that replaces credit reporting with a far less harmful, likely to cause disputes, likely to draw credit repair organization trouble. And it's how the consumer wants to be dealt with. I'm fond of telling collectors when I'm out and around, the only thing that the only people consumers want to hear from less than your damn collectors are your AI robotic collectors. They want and resist this urge too, because I hear this all the time. Well, if someone is at the payment portal, I want to call them. It's like, no, you don't. This is marketing. If someone's on your payment portal, it's because they don't want to talk to you. It's like, how often are you annoyed when you're trying to get something done on somebody's website and they keep having a little chatbot pop up and say, do you want to talk to?
Totally.
No, I'm trying to do my thing through the channel that I have chosen.
Right. Stop interrupting me. Yeah. No, I think that's totally true. And it brings us to another part of what I wanted to ask you about, which is, and maybe we'll start with your time at the CFPB and then kind of jump forward a little bit. But, for all of the problems we're talking about, and they are myriad, and I think we've touched on some of the sort of underlying systemic reasons why they exist and why they kind of get worse at different times. There's also like a lot of innovation and a lot of improvement that can be made, right? I've always looked at the debt collection space as one where, and I'm sure this will resonate with you, it never gets the investment or the resources that other parts of the organization get, right? Like collections is always the thing at the end that's like, we've been dealt a bad hand. Let's just sort of minimize our losses and do it efficiently. Like it's just not seen as a strategic priority, and therefore it doesn't seem to get a lot of technology investment. Like not a lot of engineers inside a bank or a fintech company obsessing over how to like improve the collections process. And yet, I think where that has left us is there's a lot of low-hanging fruit, right? There's a lot of like relatively simple things that we've been doing in other areas of financial services or in other industries that we can almost just adopt and pick up in collections and make huge strides, both in terms of efficiency, but also like better customer outcomes. When you were at the Bureau, and obviously you're implementing regulations for a law that's been in place for a really long time. Remember, it mentioned telegrams. And you're trying to sort of project forward-lookingness and trying to like move the market in a direction that's better for consumers. What were some of the areas you guys were thinking about in terms of like where you wanted to see innovation or progress made?
Sure. And before I address that head on, most of my career as a collector, I was an exec with bigger agencies, although I was a collector when I started. But I did have one of the client rep at Mellon Bank years ago was in sub-basement number 3. And then at one point, I met someone from Capital One, And it was in the early days of Capital One. And this guy was a marketing major. And I thought, oh my God, they're starting to put marketing people in recovery. That is so smart. And it resonated with me, Alex, because from the time I got in this business in '83, it hit me that collections is a marketing problem. You should use marketing tools to solve it. And it's got a little bit of sales at the end to, sell the consumer that there's a path to a brighter future by getting it paid, quickly as possible using whatever resources you have at your disposal. But so at the Bureau, we spent a lot of time, and I spent a lot of time on digital communications. We wanted to make sure that got ushered in. We watched various states. We watched New York and what New York did. And we said, okay, great. They clearly are contemplating digital communications with consumers. But because of the hurdle that was created was this e-sign consent, which is also an old statute that needs to be revised. I mean, I don't think there was an e-sign when e-sign was enacted. So it wasn't used. Like, you had this wonderful way that consumers could communicate with a debt collector where they're not talking to someone who might sound angry or judgy and condescending, and they can have a pleasant experience at their convenience whenever it's good for them. And it's dead. I mean, I know collectors that, you had to send a receipt for everything. So they were literally spending $1 to send a $5 receipt to a consumer because they couldn't send it electronically. So that was probably a key area. And then in my journeys with markets, I met Ohad Samet, the founder of True Accord.
Sure.
And he was the first person trying to build out a system that was based on marketing. And I mean, he had this vision of not like ever talking to a consumer. And I think that's a little too extreme. You're going to have to talk to some consumers. Ask anybody that's ever had a problem with eBay or Facebook or any of these tech giants that sort of talking to people was an afterthought. That was probably the biggest single one. We initiated coverage of artificial intelligence fairly early on, 2015 or so. We followed like the rise of Zest and Doug Merrill and some of those folks and what they were doing. And we were generally, markets was a big fan of us embracing no action letters on folks that wanted to use AI, because I used to tell my team the train's leaving the station. Okay. AI is so powerful in some use cases that industry is going to use it, whether we're knowledgeable of it or not. They're going to make business decisions to minimize risk, but we have to understand what's going on. At the same time, I'm an anti-fan of marketing puffery. And in the debt collection space, you referenced they get sort of they get the leftovers from everything else. And you just described the market right now. So what goes on in debt collections is many collectors are tied to these very old systems written on languages where the people who program in those languages are dying, they're dying of old age.
Yeah, right.
And that segment was so underserved that these CRMs were able to get away with trying to be everything to them because nobody else was knocking on their door, and that's not the case now. So they're moving towards more nimble systems. Eric Durbin and I and the markets team did an operational research where we sort of mapped the journey to hosted versions of their collection software. So they're getting better technology now, but it's still far from ideal. And many of them are still linked to very old systems. That sort of try to lock them into adopting new, better technology to reach consumers and engage with them.
Yeah, no, it's interesting. And you obviously mentioned AI, which is where I wanted to go next. It's 2026. We can't not talk about AI. I think it is worth putting it in context from what you were saying, right? Because you guys were very early on it when you were at the Bureau looking at Zest and like the use of more sophisticated machine learning models. My sense at that time was that a lot of the AI, what we called AI, was really being applied to like segmentation, right? And like being more clever about how we understand different segments of the population, what treatments to apply to those different populations, like just using math to be smarter in our collection strategies, much in the same way that for decades prior to that, people had been applying machine learning to underwriting for the same basic purpose of segmentation and pricing. That sort of came to collections. And again, in keeping with the theme we've been talking about, it came to collections like decades after it came to underwriting, because that tends to be how it goes. I want to fast forward, though, from that to the present moment, obviously. And, I imagine sometimes you think about what you'd be working on right now if you were still at the Bureau working on like debt collections, because like AI is very different now. And this has come up in some of the previous conversations I've had as a part of this series. I mean, now we have this probabilistic model, this intelligence that we can apply in lots of different areas. It's highly flexible. It thrives on lots of data, lots of context, including unstructured data, which traditionally has been very rife in the world of debt collections, right? You have records of phone calls that the customer had with a customer service agent that were difficult to parse and to analyze because it's a lot of like unstructured data. Well, we now have this like intelligence layer that we can apply everywhere. At the same time, I think debt collection is probably one of the most heavily regulated parts of the financial services ecosystem, particularly as it relates to like rules and how you're allowed to engage with a customer and what you're allowed to say and what you're not allowed to say and at what times of day you're allowed to send them messages and how many messages you can send them in a day and just many disclosures you have to make to them. Just like many, it's very prescriptive, I guess is what I'm saying, relative to other areas of regulation. And that is challenging, again, because generative AI and large language models are not exactly like deterministic rule-driven systems, right? They're probabilistic in the way they behave. So I'm curious, maybe we can start at kind of a first principles level and then we can get to some applications. But from a first principles perspective, how do you think about the application of this new form of AI to debt collection?
Sure. A lot of it goes back to some of the very first cautions about AI way back in 2014, 2015, and that was data governance. Did they start with a foundation of data governance? Do they have a permissible purpose to have that data and how they're using it? Or did they take this sort of sloppy, kind of naive approach of let's shovel everything in, and we can probably use it at some point, and we'll count on the evolution of the technology to sort of work through our unstructured data set mess to figure out what's good and what's not. Interestingly enough, sort of the biggest concern I have in AI in the debt collection space is AI puffery, and it's selling expectations that just aren't there. There's a lot of that going on. So first principles, data governance. Can you have the data, and how are you going to use it? What's the consumer outcome of using that data? And again, most responsible providers I know they're using it internally, reviewing contracts, trying to keep abreast of changes in compliance to state level, those sorts of things. As far as what you're saying to the consumer, obviously you're going to hew absolutely let word for word to any sort of disclosure, right? The model validation notice, post-date notification letter, anything like that, and then outside of that, if you have permission to have the data, can you use it to know something about that consumer where you might be able to raise the level, and your AI application becomes like the use of it in marketing, where you're determining a mix of SMS, phone calls, emails, or what the consumer looks at when they go to your website or your portal that might cause them to pay. That's where I see it going right now. But the one thing that worries me that is directly consumer harmful are new players that don't know the space and don't appreciate the compliance understructure. I ran into somebody selling outbound AI voice bots. And I said, well, how are you getting around, the post Supreme Court ruling with Facebook? How do you get around the prior consent necessity? And they said, what are you talking about? And I'm like, I'm horrified. And I'm like, okay, I wanted to sort of escort them out of the conference because they're gonna get somebody hurt. They're gonna get consumers hurt, and they're gonna cause an existential crisis to whatever agency signs them up. I think that's where it's at. I'm on record as saying I think AI is almost infrastructure. I think it's overhyped on so many levels that it gives me gas. Much like cloud, I was the I was chief marketing officer of a cloud provider when cloud was scary and everything was cloud. And then we went to blockchain, and everything is everything's blockchain powered. I think you have that here in the debt collection space, where it overcomplicates what is a simple problem. But I think if you keep it focused on it's a marketing problem, how do we get someone to engage that doesn't want to engage? Is it a settlement that's attractive? Is it the channel that you use? Is it the frequency of that channel? Do you realize they don't want to hear from you at all except through this method? And then are you using that behind, and a good use, it's more robotic process automation than anything else is. This was a owner of a healthcare collection agency that said, yeah, my clients make me furnish. I want to create a process where I have a RPA checking the balances on their system of record for daily and updating mine, so that I always know that I'm demanding the right amount of money and I'm furnishing the right. Will it completely overwhelm and revolutionize the debt collection space? Yeah, it already is, but it's a combination of digital applied with decisions made with that data, and so you've got people doing way more work with fewer collectors. It was in the old days of collections that when you met another agency owner, you said, "Oh, how big's your agency?" And they would say 500 agents.
Sure.
Now it's irrelevant. It's like it doesn't matter. You could have someone with the revenue of an old 500 person agency with 100. Like, who cares?
It's almost like people were like almost a status symbol in the old world of collections. Like, how many collectors do you have? And now, like that's disconnected. That makes sense.
Yes. No one. Like, they would puff out their chest and say 500 collectors, and some of them have been with me for 30 years.
Right.
So now it's absolutely more of that. And then the other thing is, I'm a big fan of Nicholas Carr. It's just, he reminded us again that when electricity first rolled out, you had to have a chief electricity officer because it was so revolutionary and it was going to revolutionize the industry. And I think I posted something on LinkedIn recently where, it's an image of Nabisco crackers baked by electricity. And I predicted that these companies that have AI in their name are going to kind of it'll be embarrassing in a year or two because they're just going to quietly, shave off the A and the I or make it stand for something else. I think advocates overhype the danger of AI in debt collections. I really do. But that also breaks my heart is advocates seem to dislike fintech at face value. It's just as soon as they
observe that. Yeah.
Yeah. No. For me, earned wage access is $3 per 100 better for the consumer than $15 per 100 in a payday loan with rollovers. Absolutely. So that segment of people who would get a payday loan that could actually avail themselves of an earned wage access. And it breaks my heart that consumers sort of see the two as being the same thing.
Yeah, the consumer advocacy thing, I think it's a great point, right? Because the thing that's hard about it is, and I like the way you frame, like, this is a marketing problem. The challenge is that, in certain areas in financial services, it's all puppies and sunshine and rainbows, right? It's like, we're going to market this to you because we love you and we want you to be our customer, or congratulations, we've given you a loan. Like, it's easy to love that stuff, and it's easy to love the providers that enable that stuff because no one is getting hurt and there's no hard conversations happening, right? I think the challenge and where consumer advocates often miss the mark is, I kind of call them gray areas in financial services, where it's like, look, this is a gray area. This will involve having some tough conversations. This will involve some hurt feelings and some hurt bank accounts, right? Like, there are adversarial corners of the market. We want them to be fair. We want them to not be predatory. We want them to be carefully supervised. But we also, that doesn't equal anyone doing anything innovative in those spaces as being automatically bad. And, you hear that. The EWA thing is always like, any new thing in that space is just, payday loans dressed up in new clothing. That's kind of the language that you hear. And I see a similar thing with innovation and collections where it's like, look, we can actually make some of this stuff better. And going to your earlier point about AI as a form of electricity, I very much agree with that, right? I'll give you one example that I like just to kind of noodle on where this gets applied. I don't want AI to like completely replace these systems end to end. Like, I think that would be a huge mistake on a number of different levels. But like, take something just as simple as like when you call in to pay down a debt or to get a status update on something, and you smash into an IVR system where it asks you why you're calling, and then it has to sort of like interpret what you say, but it doesn't process natural language very well. And so it has no idea what you're saying, and it's really frustrating. And finally, you find yourself just screaming into the phone, like, I want to talk to a human. Like, that is a bad experience. Everyone, including consumer advocates, should be on board with the idea of like, we can use technology to improve that. And like large language models and generative AI, if they did nothing else, could be better like listeners on those calls to then route the call to the appropriate place. So there's just all these, I think of them almost as like little micro opportunities to apply AI to make little parts better and less filled with friction. Does that make sense?
No, you're spot on. Most of my career, my job was to run a number of branches across the country. And I was fond of saying, listen, my goal is to get up in the morning and find incremental improvements but be open-minded enough to see if there's a step function, I'll grab that too. But I'm happy to close the day with some kind of incremental improvement. The IVR one's a classic because it's so dumb. The whole point of the IVR was to throttle traffic to live agents because they were scarce. Like, why are you still doing this? You can create a frictionless way for the consumer to have a pretty good experience. I will say this about collectors, and again, this is my space. I've been here forever. No people, just like bankers, no banker gets up in the morning and says, I'm going to abuse consumers, until the sun sets tonight. I might work a few overtime hours. Collectors, pretty much for the most part, same thing. They're not getting up to do bad things. And most of them actually are so terrified of state regulation that when they are using an AI, typically it's an inbound AI agent to take information for payments or route calls. They're leading with, this is an AI agent. They're actually ahead of a lot of industry where they proactively will tell you, you're talking, my name is Susie. I'm an AI agent here to assist you today. What would you like? That's good. In industry, I spent a lot of my career thinking about how we could do something dumb to get in trouble with the regulator. The Bureau, we sort of think about things that a business could do that would hurt consumers. And in collections, I think one of the senior execs in supervision, we were talking one time, she said, you know what, John? I'm not seeing that much bad stuff out there. And she came in ready to womp on industry. And by that time, we've been doing exams of debt collectors for 5 or 6 years. They get in trouble over balances. And you saw what the Bureau did in the debt buying space. Where it ended with when they got in trouble with the Bureau anymore, it was the credit reporting space. And again, I hate to circle back about this, but it's because of the fact you're not furnishing off the system of record. And I'm against imperfections in the credit reporting system, not necessarily trade lines. Like, I hate it. I personally hate this, that the credit card issuers that sell their debt delete their trade lines. And then, like, no, that's accurate information. It's negative, but it's accurate. But then it gets replaced by some of the debt buyers. And I don't like it. You're basically mucking around with the integrity of this database. And I wouldn't necessarily even be against reporting healthcare data if everybody did it, but most providers don't furnish or make their agencies furnish. It's done very inconsistently.
Yep. No, it's 100% true, and it's a problem worth kind of continuing to hammer on. John, to wrap up, one more question I want to ask you, which is, for folks who are listening, who are somewhere in their sort of collections journey, right? And it could be anything from sort of a early stage fintech company who's like thinking about building out a collections function to larger institutions that are thinking about how to kind of modernize or taking a different approach to collections. I want to ask, like, what advice you would give with one particular piece of context in mind, which something you and I were talking about before we started recording, which is, the regulatory pendulum is swinging that much further in each direction, right? And I think this is really when I talk about like, what should we be doing? What should we be thinking about? It's one of the things that's always in the back of my mind, because as much as there might be in the short term an opportunity to do things that you weren't able to do before, I also think that just based on what's happened over the last, decade plus, we have to expect that the regulatory pendulum is going to swing back the other way. And we're already seeing that a little bit at a state level, I would say. I think whether it's states or it's sort of a resurgence in the CFPB or other agencies at a federal level, like, people are going to pay for bad behavior that happens now when that pendulum swings the other way. And as is the case, there will probably be a lot of unintended consequences and other negative things that will come out of a regulatory overreaction to what might happen right now. So with that context in mind, how would you sort of advise companies to think about the approach that they want to take on collections?
Okay, I'm going to give a very selfish answer. I'm going to say engage with the regulators, engage with California, engage with New York. You reminded me of a conversation I had recently that may be applicable here. Someone said, "Oh, Rohit was terrible for the financial services industry," and I'm like, "Okay, this is a good setup." Okay, walk me through that. Like, what did Rohit do that didn't get like wiped away day one? Mm-hmm. And they came back with, well, I guess he wasn't so bad. And I said, no, he was way worse than you were even thinking about. Rohit's legacy that will harm responsible industry for years to come is he was so extreme in some of his things, followed by this, what I think is a crazy effort initially to close the CFPB. And it wasn't on that journey. It was on a journey to probably somebody like a Kathy Kraninger, Todd Zawicki type, very conservative leader, but also saw it as a very necessary regulator. Yeah. But again, I think towards the end, it led to this other extreme of let's close it entirely, which is going to prompt a change in administration and has already prompted in some states this already desire to strike back. And anything, everyone should be doing this. In my mind, consumer advocates, industry, people like me, is to fight the policy violence and try to end that cycle before we have a change in administration. I used to love asking people that never met to industry. Occasionally, we would invite them to our industry meetings and markets, and I love to get their thoughts. And you know what? They were like, no one ever said, "Oh, they were way dirtier than I thought they would be," and I would never let them in my neighborhood. They were more like, "Wow, they're really way more data driven than I realized." And they want to hear what the Bureau is up to. Again, responsible industry needs to be painted with the same kind of nuanced palette that we do any kind of consumer problem. I mean, we've got to look at it. It's not black and white. Black and white's lazy and easy, right? It's very lazy to say something's bad, or completely good. A payday has merit, right? I mean, payday went away tomorrow. What's a single father to do whose car breaks down and they got to get their kids to school?
Yeah. It's absolutely true. Well, and I think to your point, I mean, like, this gets to kind of the moment we're in right now, right? Which is that if you're industry and you have the ability maybe to take your foot off the gas as it relates to certain things, or to worry less maybe about certain things than you would have a couple of years ago. I mean, I guess the thing I always come back to is like, you should be trying to find that middle ground right now. You should, in some cases, be trying to hold yourselves perhaps to a higher standard, like especially with things like AI, where, hey, maybe there aren't exactly clear rules or guidance yet from a regulatory perspective, because all of this is so new. How do you decide where to sort of hold yourself accountable? I think you have to have this context in mind.
Yeah, it's okay. So if you're painting things in black and white, without a doubt, the Trump administration, it's a deregulatory environment right now. But what does that mean? I mean, if you're an advocate, like I've had people go to leadership at the Bureau going, "Hey, this new freedom you're giving, we don't care. We're not letting our guard down. We've got too much at stake." Yeah. I don't know anyone that is celebrating the deregulatory environment in the debt collection space. They're staying the course. They're staying the course for the states. They're staying the course because they realize, and they're praying and they're hoping that, there is a change in administration, but let's hope we get a responsible director, who follows the mission of the Bureau and realizes that consumers win when a responsible industry understands the rules of the road, and they understand those roads clear enough that they don't underserve a market because it's just completely masked in ambiguity and murk.
Right.
And that was a big part of the markets team that I ran at the Bureau, was to try to find where that was limiting the consumer. Most consumer harm we saw was not directly from a provider. It was from the fact consumers didn't have access to things they should have had access to because it was too murky. It was scary.
That's a really, really interesting perspective, and one that I think will animate the next era of how we build out a lot of this technology and a lot of these processes. John, thank you so much for taking the time. I really appreciate it. This was awesome, as I knew it would be. I'm glad we finally got a chance to do this.
Yeah, no, I'm a big fan of your stuff, and especially a lot of the stuff that you've done on open banking. And I'll be back at the drop of a hat, Alex. Just ask.
No, I will have you back again. Thank you, John. This was great.